Hello traders, Gary Wagner here. It is currently 12:06 in Honolulu, 5:06 in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the 11th day of March 2022, and this is the Daily Report for Gold and Silver, our weekend review, and an interesting week at that. There are two defining points about gold's trading activity this week. The first is that it challenged the all-time record high of 2,088, trading just $10 shy of that mark. And the second overwhelming characteristic is the fact that we had a correction, and the correction is from the lows that occurred in February when gold was trading at around $1,777 up to these highs here of about $2,075, a $300 move. And this low here, as you'll see when we pull up some charts, is right at the 38% Fibonacci retracement level. Gold did close slightly higher on the week, but lower on the day, losing $8.20, and is currently fixed below 2,000 at $1,992.30. However, on closer inspection, today's decline in gold was directly the result of dollar strength. The dollar gained 0.64% and gold lost 0.4%, indicating that there was slight buying. To further show that, I've just put up the Kitco Gold Index with spot gold trading at the time of the screen print fixed at $1,988.60, with dollar strength taking $12.40 away from the price of gold, and normal trading having fractional gains resulting in $3.80 of price increases, which gave us the net decline today in gold of $8.60. Silver only had a fractional decline today, losing about 3.5%. That's a decline of 0.14%, with the most active silver's futures contract still above $26, currently fixed at $26.22. We have been deeply focusing upon all of the fundamental events that has taken gold in a rally that's resulted in a rise of just about $300. The beginning of the rally, of course, was the ever-increasing and spiraling level of inflation, and then what kicked it into second gear, so to speak, was the invasion by Russia into Ukraine. This week, however, we hit a high just shy of the all-time record high and then began to trade lower. While it did gain on the week, the gain was slight considering the range that it traded in. And so the number one question that our viewers are asking us is whether or not what we're witnessing is an indication that there was major chart damage, and on a technical basis, whether or not gold is still in an overall bullish demeanor, or have we switched now to a bearish market? The short answer to that is, based upon what we're witnessing now, is that there was no major chart damage, and I'm going to illustrate that point by looking at two primary technical studies. We're looking at a daily chart, and on this daily chart, we have three basic moving averages. Our shortest term is the 50-day moving average. That is drawn in green, followed by the 100-day moving average in blue, and the 200-day moving average in red. Market technicians use the 200-day to ascertain the long-term bullish or bearish demeanor, 100-day the interim bullish or bearish demeanor, and of course the 50-day is a short-term indication. When we have the 50-day above the 100-day and the 100-day above the 200-day, we say that we are in a full bullish demeanor. The moving averages are moving apart. In other words, there is a divergence. The space or distance between them is widening, and you have the 50-day at the highest level, followed by the 100 and 200-day. This absolutely illustrates the fact that there has not been major chart damage. We are in a correction, and the question is, has that correction concluded, or could we see more downside price action next week? To answer that, we really want to look at another study, which is simply called Fibonacci retracement. We are looking at the same daily candlestick chart of gold that we had on our prior segment. However, on this particular chart, we've added a Fibonacci retracement. In essence, we start from the low that occurred at the end of January when gold was trading at $1,782, up to the most recent high that occurred on Tuesday of this week, and then the subsequent price decline. Fibonacci retracement looks at key levels such as the 23.6% retracement, the 38.2% retracement, and the 61.8% retracement. Stock traders have added in the 50% retracement, and it is a useful number to look at. What we can derive from this chart is that after rising about $300, the market has declined or given back approximately 38.2%. I say approximately because the low is just slightly below that. This is absolutely an acceptable level for a correction. But this would be a shallow correction, because if the retracement is either 23.6 or 38.2, we label it as a shallow correction. While it is too early to tell if we'll find price support at this level, and next week we see prices return into rally mode, or a continuation of the price decline cannot be determined by price action as of today. We'll have to wait till we get our first reading next week on Monday. And if prices stabilize and we have an up day, meaning a green candle that has a higher high and a higher low than today's action, that will be a solid indication that the correction has concluded and we've gone into rally mode. If the opposite occurs and on Monday we see a further decline in pricing, meaning a lower low and a lower high, and it would be a red candle, then we would typically look to see how the market reacts if it trades as low as $1,928, or a deep correction, which would take it below $1,900 to $1,894. As you know, we pulled really respectable profits this week as our stop was hit at $1,995. We gained about $100 per ounce on the trade, which results in a profit of about $10,000 per Comex contract. We also talked about looking for a price point to enter the market, and we were assuming that we were not going to go into a full corrective mode. However, that assumption was invalidated today with this lower low and lower high. So based upon the most recent activity, we are neutral as we go in over the weekend with no active trades. We will look at price action on Monday to see which way the market wants to track from there, whether we have a bounce to the upside or a continuation of the selling pressure. That will determine our next action. This has been Gary Wagner wishing you, as always, good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.